Hey everyone, we are back. Make sure you have your cameras on. Cameras, everyone, please. All right, good. We got everybody back. Julia's somewhere. Danny's on the phone. Leonard is somewhere. Oh, there he is. Okay. All right. Mr. Badur, going back to page 244, I think I erased the notes. And I mean, I charge like $10 per page to go back. So let's see what page we're at. Quick. We're at page 249, so start counting. More. 244. This is what I had on 244. Nothing else. Is it this that you want to see? Okay. You want to pose? Oh, you're good? Okay. I wasn't ready for it. I just wanted to know. All right, back to page 249. All right, Jen is here. Who else is out there? Is it Ruth? Just click. Ready? All right, so initiating a mortgage loan. There's the loan application, which everybody knows what it is, right? When you apply for the loan and they ask for everything possible of you, right? What is your name? What is your address? What is your date of birth? What's your social? What's your blood type? What's your dog's name? What's your neighbor's name? Do they have kids that you can use them for the loan as well? Right? They ask you a bunch of stuff, right? Asking for a bunch of stuff in order to approve you, right? So in the loan application, right, the traditional loan application that most lenders use, it's called the 1003. You guys don't need to know the 1003, but it's a uniform residential loan application promulgated or created by Fannie Mae, which we'll talk about tomorrow, right? In addition, the application must include, again, all this stuff. So the application must include, if it's a property that's being refinanced, for instance, must even include the current loan balance. But as far as everything else of the property, the age and the year built, again, everything else is for refinance. As far as you, age, employment, assets, education, monthly income and expenses, and debt. And then we have to have supporting documentation or supplemental documentation, which would be the appraisal report the value of the house, right? The purchase contract with the terms, the loan terms, the credit report, the income and employment verification, and so on. So all this stuff is asked of you to establish stability, right? Once they establish stability through the process of underwriting, okay, so the risk assessment, okay, once they establish stability through risk assessment, all right, Tiana, all right, all right, all right, get it, get it. Fine. Better? Yes? Okay, hold on. Can you see it? Yeah? Okay, cool. So underwriting is risk assessment where the underwriter assesses the risk of lending to you. That's what it is. So what they're going to do is evaluate your ability to repay the loan. They're going to appraise the value of the property offered as a security, and they can determine the terms of the loan, right? So that's the risk assessment. Now, in the process of qualification, the reason why they ask information about the house is because they're going to qualify both you as an individual and the ability to pay it back, and the house, right? And the value of the house. Because if they so you're blind, that's what it is. You ran out of contacts. Tell me what's your prescription? I might have some contacts. Anyway, I have extra. Anyway, so they're going to qualify both you and the house, right? Because a house must be worth whatever they're lending. If the house is worth $500,000, but you're asking for $600,000, the lender has the right to say no, because you're asking for too much money versus the value of the house, right? They also have the right to say, if you really want the house, the down payment usually is 20%, but you got to come up with a difference. Let's say they approve you for 500, you got to come up with 20%. That's 100, right? But the house, you're buying it for 600. So you got to come up with another $100,000. So pretty much your down payment on this thing is going to be $200,000 to buy a $500,000 house. Only because the property is not worth it. The lender will never lend more than what the appraised value is. Okay, so you have to come up with that difference. So they will check all this stuff. They'll check also your income, cash resources, creditworthiness, net worth, employment stability, and so on. Once you get that qualification or that approval, make sure you don't change anything about your lifestyle. Don't change anything about your debts. Don't change anything at all. Okay? Don't change jobs. Nothing. Until you close. After you close, you can do whatever you want. Until you close, please don't change anything. You got to make sure not even the way you eat. Don't change the way you eat. I was gonna say don't even breathe. I don't know how the way you eat will change the loan. Okay. So right before the closing table, make sure when you sit down the same way you sit down to eat. Fork on the left, knife on the right, and so on. That's what Danny is saying. So just don't change your lifestyle, because everything is based. Loan to value is going to be based on the value of the house, and then we also have, which we'll talk about in a little bit, we have the loan to value ratios, right? Which is your debt, right? So your debt cannot be more than X percentage of income. Okay, so pre-tax is the gross income. So again, you cannot change anything about your lifestyle, not even the way you eat. There you go. Until we close. Then after that, you can do whatever you want. Okay. So going back. Now the lender gives you a loan based on the loan to value ratio. So the lender will say, hey, you're approved at 80%, okay, LTV. When they say 80% LTV, this is the same as putting 20% down payment to equal 100% purchase or value. Because most of the times we purchase for whatever value. We don't purchase for more than what it's worth. So again, 80% LTV or loan to value ratio means that you put 20% down to complete the 100% value. So if the property right here, if the property is bought for 100,000, then the loan is 80,000. How much is your down payment? Okay, down payment is 20,000. So the LTV or loan to value ratio is literally based on that. It's value, which most of the times is the purchase price, right? Minus LTV equals down payment. Or it could be value minus down payment equals LTV. So sometimes they say, hey, you got to come up with 3.5% down payment. If it's an FHA loan, you got to come up with 3.5% down payment. If it's 3.5% down payment, right? Then how much is the LTV? Simple, 96.5. That's going to be your loan. So if you bought a house for 100,000, your loan is going to be 96,500 because it's always based on 100% value. So LTV and DP or down payments, these are interchangeable and they're always based on 100% value. Whatever the value they say, so they appraise for 100,000, it's based on that. They appraise for 200,000, it's based on that. They appraise for 300,000, it's based on that. They'll tell you that the maximum loan amount or LTV, okay, this is called max loan amount, is going to be 80%, or it's going to be 96.5%. Okay, that's the max loan amount. Good? I'll give you some time to look at it. Any questions? Let me know if you have questions on this before I proceed. Meanwhile, I'm just doing something real quick. Questions? Come on, guys. None? So you guys got it. 100%. We're good. Great. All right. No questions from YouTube. No questions from Zoomers. We're good to go. Qualifying a mortgage loan. Qualifying a mortgage loan. There's something called EQA, or Equal Credit Opportunity Act. And that, I don't think I have to explain now. It means that everybody, I don't have to go in detail now. We have a whole discrimination chapter. But it means that everybody equally qualifies for credit, right? Application at least. So everybody can apply for it. And my application cannot be different than your application. My criteria cannot be different than your criteria. All right, so that's what it means. There's an income qualification. Skip this for now. And we are on page 252. There's an income qualification, which will verify what is your current income. How much money are you making now, right? And also what assets you have, all right, excluding the property. To verify your current employment status, I'm sorry, I'm zooming to assist the blind people, okay? So the current employment status, credit history, so check your credit report. What's going to be the potential monthly payment for the mortgage? Monthly payments being made on other loans on the same property. Monthly payments for other mortgage-related expenses or debts. And monthly payments compared to monthly income, which are called debt-to-income ratio. Okay, debt-to-income ratio. And I'm going to go over debt-to-income ratio in a second. Okay, then we have qualified more. And by the way, I think I have also a video on debt-to-income ratio on YouTube. So if you guys need more of that, just go to the YouTube channel. Look for the explanations there. Qualified mortgage. A qualified mortgage is one that meets the ability to repay. Okay? So this has certain required features and is not allowed to have others. There are exceptions to these rules for certain kinds of smaller lenders. Issuing a qualified mortgage gives the lender certain legal protections in the case that the borrower fails to repay the loan. Generally not allowed in a qualified mortgage, and I'll explain better qualified mortgage in a second. What generally is not allowed in a qualified mortgage is an interest-only period. What is interest-only? It means you're not paying the debt at all. You're just paying interest. Okay? Interest-only period. That means that at the end of that period, you still have the full principal to pay. What is not allowed in this type of loan is also a negative amortization. Negative amortization is where the principal is increasing instead of decreasing. Okay? So that means you're paying, and still have more to pay instead of less to pay. What is not allowed in these types of loans is a balloon payment. A balloon payment is a larger than normal payment. We're going to talk about that in a second. It's a larger than normal payments at the end of the loan term. So you have your normal payments of $1,000 a month, right? And then 30 years later, you have to pay $100,000 as an example. Okay? This is a balloon. A balloon because it's inflated, right? It's an inflated payment. You're used to $1,000 and then all of a sudden you have $100,000 to pay, right? So balloon payment means larger than the normal payments you're making. It could have been $10,000, right? It could even be $5,000. It's still more than what your regular monthly payment was. That's what makes a balloon payment, okay? A qualified mortgage cannot be more than 30 years and cannot charge upfront fees and points, excessive upfront fees and points. Now, generally required, the traditional requirements is that your DTI or monthly debt is no more than 43% of your pre-tax income. Okay? And there's a limitation on points. Can anybody tell me what a point is? Anybody? Points? What is a point? One percent of what, Sam? Make sure you change your name, your email. Nard says discount points. Great. So discount points is 1% of the loan. Thank you, guys. So discount point, thank you, Clenard, is 1%, thank you, Sam, of the loan. Thank you, Sinead. So, see, teamwork. Unfortunately, during the state exam, you're by yourselves. But teamwork, love it. Love it. There you go. But it's 1% of the loan amount, correct. So they cannot charge you excessive points either. That's what we're saying in the qualified mortgage. Now, qualified mortgage include loans that can be bought by Fannie Mae or Freddie Mac, or insured by government agencies like FHA, for instance. Okay. Some loans. Let's do this. All right. Next page, we have income qualification, and we're going to talk about DTI. There's the front end DTI, and there's the back end DTI. Okay? So this is the things we're going to learn right now. Front end DTI and back end DTI. Okay? Ready? So, what is the income ratio? Income ratio is where they feel that it's going to be a safe level between the debts that you have or that you are about to incur. It will be a safe level for you to still pay the mortgage. If your DTI, if your debt to income ratio is too high, then you're high risk. So let's say, as an example, you have a credit card of $1,000. That's your limit. Right? This has nothing to do with the actual formula and the mortgage and whatever. It's just as an example. If your credit card has a $1,000 limit, right, and you're using $900, then you are considered high risk. You understand? So if you're at the limit of your credit card, this is true with everything. If you're at the limit of your credit card, you're considered high risk. If you use 400 of it, then you're medium risk. Okay? If you're using 300 or less, right? So 300 or less, then you are considered low risk. So always try to keep your credit cards at below 30%. I know the banks are always betting against us, so remember that. The banks are betting against us. They give you $1,000, but if you want to have good credit, only use a little bit. They're giving you money, and they're like, hey, here's $1,000, use it, right? But then your credit goes down the more you use it. If you don't pay it off and leave at least less than 300 by the time that they close the cycle. So you want to be low risk, be below 30%. This is a good, 30% is a good DTI ratio, debt to income ratio. In terms of housing, it's the same thing. They're going to look at all your expenses, your monthly expenses, and we're not talking about groceries, we're not talking about utilities, we're talking about monthly expenses that would involve credit. They're going to look at all of it, they're going to look at your income, right? And they're going to determine where you are. So the front end income ratio, is called housing expense, and this is your PITI. PITI is principal, interest, taxes, and insurance. This is your front end ratio. So when a loan officer says, hey, your front end ratio is too high, okay, that means you don't qualify for the mortgage. The payment of that house is going to be too high on the front end ratio. That's it, right? So monthly housing expense, they say it's going to be $300,000. I'm sorry, it's going to be $3,000 a month. they're going to divide by your gross income or pre-tax income, and it's going to give the income ratio. So as an example, most conventional lenders require the ratio to be no more than 25 to 28%. 28% is the common out there. Okay? In other words, a borrower's total housing expenses cannot exceed 28% of gross income. For an FHA-backed loan, the ratio is 31%. That means your mortgage cannot be more than 31% of your gross income. So as an example right here, if a couple, and this could be a question in the state exam, by the way, there's a similar question to this in the exam. And the question could be, there's a couple that makes $12,000 a month, right? Monthly gross income. And the maximum, lender's maximum income ratio is 20%. So they'll give you these two numbers. The couple's monthly expense cannot exceed, they put a question mark, right? In this case, they'll tell you the answer, but they'll put a question mark. All you have to do, literally, is multiply their income by the ratio. That means that the maximum PITI, this is the max PITI, your mortgage cannot be more, with taxes and insurance, cannot be more than $3,360. $3,360. Got it? What they do sometimes in the state exam also, or the school exam even, is they give you, they'll tell you the yearly gross income, and they put 144,000 as an example, right? Just throwing a number, 144,000. That's what they'll give you. This number is calculated on monthly. So you would have to divide by 12 before you do this math. Okay? You guys good? Your faces don't tell me you're good. Your thumbs are up, but your faces are not. Hold on, Tiana. You cannot even see what's on the screen and you give me thumbs up? Come on. Oh, you can hear me. Okay, cool. I thought without contact you couldn't, you know, because you keep on yelling at me over the camera, so I'm not sure if you can. Oh, okay, good. All right. All right, so that's how we consider the front end ratio. Now, there's something called debt ratio, and this is the back end. Okay? The back end ratio is the same as before, PITI, but now we're going to include, Tiana, look at the screen. I'm zooming for you, all right? So now we're going to include PITI like we did before, so that's your principal, interest, tax, and insurance. But now we're going to include other debt obligations like a car, credit cards, and other loans. Right? So anything that's a financial debt. Debt are not expenses. Okay? So we're not looking at utilities. We're not looking at your groceries. We're not looking at how much you spend on going out to dinner. Right? What we're looking at is you got a car, you have credit cards, you have student loans, you have personal loans. We're going to look at everything that's debt that you owe somebody else. Okay? So at this point, we calculate the total of these two. Calculate the total of these two. And the calculation is also dividing by your monthly gross income. And it gives us the debt ratio. So So the difference, the only calculation difference between this one and the previous one is that we're adding all your other debt bills. Okay, so that's the only difference. So if you look at the example, for conventional lenders, the back-end ratio is no more than 36%. For FHA, 43%. And if it's VA, it's 41%. But state exam, if anything, they'll give you the FHA or the conventional. And they'll give you the numbers, by the way. They'll give you these numbers. But it's good for us to know when we're talking to somebody that wants to buy, right? We don't do the mortgage, but it's good for us to know the 2836 for conventional or the 3143 for FHA. Could some lenders go higher than these? Sure, because these are FHA guidelines, but I can do whatever I want. It's my bank. So FHA says minimum, or I'm sorry, maximum is this. But if the bank wants to get away from FHA, right, or they have another program to support, they can go higher than that. So I've seen lenders do 43.55, where the back end ratio is 55. So with all your debts and everything, no more than 55%. All right, very dangerous, but yeah. All right, so let's do the calculation here. Same example. The question, actually, let me go here. The question says that the couple, using the 36% debt ratio, they'll give you this in the exam, using the 36% debt ratio, they have a monthly income of $12,000. What is the max that they can afford on the mortgage plus debts? What is the max that they can afford? Well, 12,000 times 36%. So the max that they can afford, right? PITI plus other debts or other loans. The max they can afford is 4,320. So if you guys remember, the front end ratio allows them no more than 3,360, if I'm not mistaken. Yep. So the front end ratio for the same couple, the front end ratio was 3,360 or 4,320. Right? So these are the max that we can have for the house, max we can have for the house and other loans. So if your car payment is $600, right? If your car payment is $600, then we have here is $3,720, right? And then if your credit card payments are another $400, then that's $3,320. So the max that you can really afford is whatever is the lesser of these two. So your mortgage has now been reduced by $40. Okay? So instead of $3,320, the max that you can afford is $3,320. And if you have personal loans, minus $200 a month of personal loans, then $3,120 is the max that you can afford. That's what the front end ratio and the back end ratio do. Front end ratio says for housing, if you have no debts, that's the max you can afford. The back end ratio is, oh, you got debts? We got to deduct all these to figure out what's the max that you can. Whichever's the lesser of these two is what you get. In this case, right there. You guys understand? So if you had no debts, let me erase this now. If you have no debts, what would be the max you can afford? I appreciate you pointing. Jenny's like, like I don't know. First of all, flip screen. The lesser of the two. The lesser of the two. The lesser of the two. What they give you here is a cushion for debts. So they'll allow you to have a car and all that stuff as long as it doesn't exceed 4,320 in total. Right? But what's the max you can afford is the lesser of the two. So 3,000. It's the way it is. It's the lesser of the two. If you have no debts, it's the front end ratio only. Okay? This is why I explain this stuff, because most people don't explain. Right? Let's see. Cash for qualification. All right. So you got to have something called cash reserves. You have to have money in the bank. And this is another reason why I go really slow here for you guys to understand. I'm already getting you guys started in the real estate business, not just getting to the license. But cash qualification, if somebody says, oh, the loans right now, 3.5% is all I need. I got it. I'm buying a $100,000 house, so I have the 3,500. Great. All right. With 3,500, could you buy a house? If it's $100,000, yes. But that's towards the loan. The lender doesn't want to see just a down payment, right? If the mortgage is going to be $1,000 a month, as an example, they want 6 months reserves. So another $6,000 if it's $1,000 a month. Okay? And, guys, there's also something called closing costs, which could be another, let's say, another $5,000. So how much money must you have in the bank? Are you guys understanding? This is the reason why people sometimes get upset. Oh, my realtor sucks. My realtor could not get me the house. Or the mortgage guy that he referred, or the mortgage gal that he referred, they asked for more money. I only need a 35. No, guys. The reason why you need it is because the banking guidelines, they can ask for reserves. The closing guidelines usually put the majority of the burden for closing costs on the buyer. So unless we negotiate with the seller, for instance, right? Unless we negotiate with the seller, hey, get me $10,000 seller's concession. Right? So get me a $10,000 seller's concession. Then all you need to come up with is $4,500 for the buyer. You guys understand? Unless we negotiate with a seller, to contribute towards the closing costs, right? And I threw $10,000 just for throwing it out here because there's limits. For FHA, you cannot put more than 6%. Let's say it was a $100,000 purchase. You cannot put more, sellers cannot contribute more than 6% of the loan amount. So the max they would do on this one would be $6,000. But anyway, so you have to come up with this money. If the seller says, like we're in the seller's market, the seller literally can say, you don't have the money? Thank you. Next. Right? That's it. Simple. You don't have it? There's somebody else. There's so many people want to buy. Why would I worry about you? Oh, but I'm your cousin. I don't care. Money's money. All right? So next. All right? I'm not going to give you money because you're my cousin. I know it's a hot market. So I'm going to go with the non-cousin. You get it? About money. So make sure you guys understand there are some other requirements, reserves that you have to have. If you don't have the money, you can get a gift from a relative or a friend. So aside from the seller's concession that we talked about, you can get a gift from a gift from a friend or a relative. But they also have to sign an affidavit called a gift letter affidavit that explains to the world that your relative or your friend is gifting the money, not lending them. Got it? So I'm literally giving you $10,000 towards your closing costs. I'm your friend or relative. I'm giving you $10,000 and I don't expect to get paid back. Are you guys understand this? It has to be a true gift, not a loan. Okay? Nothing stops in the future. Nothing stops in the future. If I go buy a house and you have the money, nothing stops you from gifting to me the amount as well. But this cannot be a loan. It has to be a true gift. You guys got it? For this transaction, it has to be a true gift, not expect payment later on. That's the way it is. True gift. Mr. Brother, yeah, depends on the type of loan. The maximum that you can put as a gift depends on the type of loan. So there's FHA, there's VAs, there's conventional loans. Within FHA, there's different types of loans. Within conventional, within VA, there's different types of loans. So it depends on that. Okay. Are you guys good so far? Great. Can you buy a house with no money down? Find a friend to gift you money. Get the seller to pay for closing costs. There you go. No money down. There's always a way. Somebody's hurting. Not me, but somebody's hurting. The friend that gave you the money is hurting because they don't get the money back. All right. They're going to pull your credit report and credit score, right? And when we're talking about the credit report and credit score, there's different criteria for credit, right? So you don't have to, okay? And I'm not going to show on the screen for everybody here to see, on YouTube. But have you guys ever checked like Credit Karma or something like that, or Credit Sesame and all those? Anybody? Okay. If you check Credit Karma, what is your credit score on Credit Karma? Can anybody tell me? If you want. If you don't want, it's fine. I'll come up with another. It's okay to say you have a bad score. It's okay. Okay, not bad. All right, cool. Diana says good, fair. Brother says last I checked, the bank 790. Okay, great. Anybody else? Are you guys reserved? Like, no, I don't want you to know my score. Okay. It's always different than on the bureau. That's what I was going to try to get at. All right, we got a 620, got a 679, we have a 790, we got a 729. Listen, here's what you need to know about Credit Karma, Credit Sesame, and all these BS sites. They are free, sure, they're free, but they don't give you. Sam, I know yours is above 900. I know. I saw it the other day. All right. But they don't give you the real numbers. And even if you go through Experian, TransUnion, and Equifax, which is where you should go to get your credit score, the real credit scores, right? Even if you go through those, there's different types of FICO models, right? And depending on the type of loan you're getting, there's something called a Vantage score or model. All right? So there's FICO 8, there's FICO 10, there's Vantage Model 3 and 4 and 5. It depends on what you're trying to get. If you go for a car, see, Credit Karma could show that you have 670. But the real FICO, so Credit Karma, but the real FICO is going to show that you have 640. Simple. If you pulled your credit, the tri-merge report, so from Equifax, and they included TransUnion and Equifax as well, Experian as well, and that score says you're at 700, that's great, but for what? Okay, for what? So you got to look at, are you buying a car? For a car, based on the different models that they use to qualify for a car, maybe your score is 720. For a house, maybe your score is 690. They have different models, so don't rely 100% on these scores. Don't rely 100% on the Credit Karma. Like, they are a marketing company. Credit Karma is a marketing company. They give you the free reports, but then they sell you a bunch of stuff on the app. And if you don't pay attention when they're telling you, hey, you know what it would be good right now for you to get a new credit card, and it looks like you qualify for it. Click here, right? And then once you click, it says, we are not responsible for your application. If you don't get approved, it wasn't us, it was them. Right? Because they got sued so many times already. Credit Karma got huge lawsuits for advertising this score, telling you apply for a credit card or apply for a car loan or apply for a mortgage. And then the moment you go to the site of the vendor that's going to approve you, right? The moment you go there, they check your credit, hits a serious inquiry or a hard inquiry on your credit versus a soft inquiry. That's what this is. Hard inquiry on your credit, drops your credit, tells you you're not approved, and now Credit Karma is like, oh, hey, your new score is 610. What happened? They literally send you a message later saying, it looks like your score dropped. Like, what happened? This is what could have happened. Oh, there's an inquiry. They literally marketed you to another company. You clicked on it. You fell for the trap. Did not get approved. Your score dropped. And now to get the next credit card or loan, it costs you more interest, right? And that's how these companies run, selling false advertisement, because that's what it is. That's not your score, okay? Your score, the best score, is the one that you're going to pull from Experian, from TransUnion, or Equifax directly. Those are going to be your best scores. And even within that, like I said, there's different models. Are you buying a car? Are you buying a house? Right? So this is your generic score. This is your score for a car, score for a house, score for a personal loan. Right? You guys got it? I don't when the buyer tells me my score is 800, I'm like, great, where did you get that? Credit Karma. I'm like, okay. Let's sit down with the mortgage lender so they can pull your score for mortgage purposes and figure out exactly what your score is for mortgage purposes. Make sure you explain this to them. This right here. For mortgage purposes, for car purposes, different scores, different models. All right, Valerie just said thank you. You're welcome. I guess I helped you in some way. Love it. So Valerie just says, I am at another school, but I'm referring people to your class. I appreciate it. Really love that. Thank you. I'm glad I can help somehow. All right. So again, the lender can deny the loan because you thought you had an X score when you in fact have a Y score, right? But I don't know if you've noticed when you apply for credit and they say, hey, you didn't qualify, right? They have to send you a letter that says why you didn't qualify. Now, they don't send you all the details of why you did not qualify. They give you a generic, hey, you have too many accounts or not enough accounts in good standing, whatever. But they have to disclose in writing that you're entitled to get a statement of a reason from any creditor responsible for a negative report. So you can get the statement of where they pulled the information, and now you contact that bureau to get the copy of your report and know exactly what's on your credit. All right? Very important. Okay? Once everything is approved, they give you what's called a loan commitment. That pre-approval you guys want. It's a loan commitment. Is where the lender is saying, hey, we checked everything out, and you check out. You're good. We're going to lend to you. This is going to be the max that we'll lend to you. This is the interest rate that's going to be attached to that loan, right? And this is the down payments that we expect based on this type of program. With that being said, happy hunting. Go look for a house, right? That's what it is. You want to have a pre-approval, and then you want to have the final commitment, which now is with the actual house in place. Okay? There's something called firm commitment. It's a straightforward offer to make a specific loan at a specific interest for a specific term. We said that. There's the lock-in commitment. And the lock-in commitment or rate lock is, hey, listen, you approved at current interest rates of 2.75%. You have 30 days or 60 days or 90 days to close. We're locking the rate. So it doesn't matter. So you got approved at 2.75%. Today. If 90 days later, interest rates went up to 5%, okay? If interest rates went up to 5%, don't worry. Your interest rate is locked at 2.75, okay? But you have these 90 days to close. Beyond the 90 days, you might have to pay a daily rate to keep that lock. You guys understand? The problem with rate locks is if, for any odd reason, because now we have historical low rates, but for any odd reason, if the rates drop to 1.5%, yeah, it sucks. You locked your rate at 2.75. You got it? So the lock works either up or down. This is the loan you're getting at 2.75%. You guys got it? So the rate lock or lock-in commitment is, doesn't matter what happened to the rates, this is what you're going to pay in interest. After 90 days or 60 days or whatever it is, we don't guarantee anymore. Okay? Next thing we have is closing a loan. You're probably thinking, closing a loan. We don't close loans, we close on houses, right? No, we close on the loan. And once the loan is closed, we close on a house. Now, technically, these two happen at the same time, meaning the same day. Okay? Once the money is transferred to the escrow agent, whoever's closing, right? Once the money is wired there, then we have the final clear to close. Hey, everybody, the money's in the account. Here's the keys. Here's the deed. That's it. Right? Exchange monies, everything is done. That's the closing of a loan. Okay? So it normally occurs at the closing of the real estate transaction. Okay, so closing of a loan means the money was wired at the time of closing, so we can now fund the transaction and get the key, sign the deed. Okay, so there's two closings that happen at the closing: closing of the loan and the actual closing itself. Okay. All right, this is the last thing we're going to cover, and then tomorrow we'll cover the rest of this chapter. So, laws affecting mortgage lending. Laws affecting mortgage lending. We have the Truth in Lending, or the Regulation Z. We have ECO that we talked about before, Equal Credit Opportunity Act. We have the Real Estate Settlement Procedures Act and the National Flood Insurance Act. The two that I'm going to focus on is the Truth in Lending and the RESPA, Real Estate Settlement Procedures Act. So when you see these, okay, I'm not going to talk about this in detail, or this one's easy, flood zone, flood insurance, period. Okay, Equal Credit Opportunity Act, everybody's entitled to apply for credit, period. But these two, Truth in Lending and Regulation Z, These are called TILA. So actually, let me make it nice and neat for down to there. So E I L A, and the other one is R E S E E C T. Find out. Oh. RESPA, R-E-S-P-A. At least I can guarantee you never have a dull moment, right? All right. So these are the two that you guys need to remember. These are the TILA, or Truth in Lending Act, and RESPA disclosures. These are required in every residential and federally related transaction. So TILA and Regulation Z, very important, very, very important. All right. So the Consumer Credit Protection Act, enabled in 1969 and since amended by the Truth in Lending Simplification and Reform Act, simply known as Truth in Lending Act, is implemented by the Federal Reserve's Regulation Z. Now, Regulation Z applies to residential. Regulation Z applies to residential. It does not apply to commercial. So if it's a residential property, 1 to 4 family or single vacant lots, right? Regulation Z applies. I will explain what Regulation Z is in a second. But you got to remember, it does not apply to commercial. Regulation Z does not apply to commercial. And commercial is 5 units or more, industrial, warehousing, businesses, right? Does not apply to that. Regulation Z applies to residential only. Make sure you write that down somewhere. Okay. Now, what regulation covers is the disclosure of costs. So if you guys remember APR, okay, the true cost with other charges, right? It covers the right to rescind a credit transaction or cancel a credit transaction. It covers advertising credit offers, so what you can say or not say when advertising a loan, right? And what must you include depending on what you say. And then penalties for non-compliance with the act. Regulation Z. Okay? Under Regulation Z, a lender must disclose the annualized percentage rate, or the annual percentage rate, called APR. So if they ask you in the state exam, which act or which law forces lenders to disclose the true cost or the APR? Regulation Z. If they ask you, what does Regulation Z do? Right? Usually the answer is not going to be anything about marketing. The answer is going to be the true cost of financing, or APR. Okay? That's what Regulation Z is all about, to allow you to explore different options. If you guys remember APR for Bank of America or APR for Wells Fargo, in the example I gave you guys earlier, the APR was different, even though the pure interest or the basic interest was the same. Because APR includes the total costs of carrying that loan. Okay? For instance, fees for appraisal, title, credit report, survey, legal work must be added as well. Okay? Rescission. Rescission is one of the things that must be included in the creditor's advertisement, so lender's advertisement. And rescission means to cancel. You can cancel a loan within 3, it's supposed to say business days, all right? 3 business days. You can cancel a loan within 3 business days, right? But this does not apply to residential. Again, right? Regulation Z applies to residential only, the true cost of financing and all that being advertised, right? The rescission clause that allows you to cancel a loan does not apply to residential, first of all. And second, does not apply to the finance of a purchase. Okay? So the rescission, I want you to remember that it's for refi only. For refinancing only. The rescission or the right to cancel a loan applies to refi only, not for purchase. Okay? As far as advertising, there's a few things that we must include in our advertisement, and there's things that we cannot include in our, or should not include in the advertisement. Okay? If there's things that you will state or disclose, then Regulation Z says, well, if you said that, then you have to say a few more things. For instance, if I give you a down payment percentage, right? If I tell you the installment payment amount, so hey, you're going to pay $1,500 for this. If I tell you about the specific amount of finance charge, specific number of payments, repayment period, or that there's no charge for credit, so any of these will require more disclosures. If we don't disclose the down payments, percentage, repayment terms, APR, whether the rate can be increased after getting the loan, if we don't disclose that, then we are in non-compliance with the law, and it costs up to $5,000, by the way, per day. Okay? $5,000 per day that the violation continues. All right? So it is very important, let's go back here. It's very important that the terms are liberal terms, meaning nothing specific. If I tell you that the payment is going to be $1,500 a month, my question to you guys is very simple. Do we all have the same income, guys? Do we have the same income? No. Do we have the same credit score? No. Do we have the same amount of money in the bank account? No. Do we have the same job? No. So everybody is different. Everybody has their own financial fingerprint. So for me to say that the payment of this house is going to be $1,500 a month, right? That means I use this number based on a model. What is the model? Based on somebody with a 720 score? Based on somebody with a 640? How did I get to this number? What was the interest rate that I applied to come up with this number? What was the down payment I expected to come up with this number? Do you guys understand? So because everybody's different, any of these disclosures here will require us to disclose more stuff. So again, if I disclose one of those, then I must include the rest of them. That's pretty much what we're saying. Okay? And if I don't, $5,000 per day. All right. Next we have RESPA. Okay? RESPA. So what is RESPA? Real Estate Settlement Procedures Act, right? I mean, you guys can read, some of you. You can read. But what does this mean? Real Estate Settlement Procedures Act. Or let's take the act out of this. That's right, Valerie. So the valuables are different, therefore different value. Correct. So what does real estate settlement procedures mean? Can anybody tell me? Correct, Sam. All right. What does real estate settlement procedures mean? Do not try to read anywhere else. Okay? Just tell me what you think it means. Okay? Real estate settlement procedure. Make sure I zoom in more so You guys know what I'm talking about. Real estate settlement. What does that mean? What is a settlement? That's what we're trying to get at. Because then you'll remember what RESPA is for. That's why I want to know real estate settlement. The first one, TILA, is easy. Truth in Lending Act. So lending, so financing, right? What is real estate settlement? Down as when everything is done. Okay. Some of you are trying to read in the book. Throw something at me. Leonard, perfect. Sold. That's it. Right here. That's the answer. Okay. This is the answer. Settlement is closing. So RESPA talks about the procedures or the process to close on a real estate transaction. At closing, we settle what our agreements were, right? So we settle all the debts. If there's a mortgage to be paid off, if there's a tax to be paid off, if there's water to be paid off on the seller side, settled. For the buyer, it's the closing of the loan and the transfer of the money. We settle at closing, right? So Real Estate Settlement Procedures Act is the process that we have to go through to get to the closing, right? The thing about RESPA, okay, and think of R, I know it's real estate, but think of R for residential, applies just like TILA. RESPA and TILA both apply to residential only, okay? Both RESPA and TILA apply to residential only. Valerie, perfect. Settlement equals closing on an agreement. Yes. Okay. So RESPA applies to the settlement costs. What does that mean? It means that the same way, guys, the same way with Regulation Z, you are entitled to know the true cost of financing, like how much is this loan going to cost me, right? The same way you're entitled to know with TILA, with RESPA it says, hey, guys, this is how much you're going to pay at closing. These are the settlement costs, right? If you guys remember, I wrote down it's not just the down payment. You have settlement costs also, like closing costs, right? So it have to tell you how much money you must bring at closing to actually close. Okay? So RESPA is about knowing the settlement clause. And it only applies to purchases. Okay? It only applies to purchases of residential property. Okay? This is for VA and FHA loans, government-backed or assisted loans, loans that will be sold on the secondary market, which we'll talk about tomorrow, on the secondary market to Fannie Mae, Freddie Mac, or Ginnie Mae, and loans made by lenders who originate more than $1 million per year in residential loans. So RESPA, again, TILA is for loans. Write this down somewhere. TILA is the true cost of a loan or financing, right? TILA is the true cost of a loan or financing, okay? RESPA is the true costs of closing. So both of these are disclosures of closing residential. Both apply to residential. These are disclosures to make you aware of what's the final cost of buying and borrowing money. Okay, so TILA is for the loan, RESPA is for the closing. Both of them apply to residential only. Okay? Sorry, residential purchase only. Put that. Residential purchase only. Yes, Valerie, perfect. There you go. So when you see in the state exam, TILA, Truth in Lending Act, or RESPA, Real Estate Settlement Procedure Act, one is for loan, the other one is for closing costs. You guys with me on this? Thumbs up? All right, cool. Ask for thumbs up. Tiana goes like, I don't know. Our affiliate doesn't even answer anymore. You guys good? We're almost done. All right, so in addition to imposing settlement procedures, RESPA also has provisions that prohibit Valerie's dabbing. All right. I didn't even know that on YouTube there's an emoji for dab. Anyway, so in addition to imposing settlement procedures, RESPA provisions prohibit lenders from paying kickbacks. So this is Section 8 of RESPA. So Section 8 of RESPA, right? And there's Section 9 and so on. This is the Act. Says no kickbacks. What does that mean? Well, if I'm a loan officer and you're a realtor and you refer business to me, I cannot give you any money for you referring the business to me. I cannot give you any kickback for you referring business to me. The same way that I cannot give you money for referring a buyer to me, a borrower to me. Are you guys understanding? So we can do leads referrals. That's not a problem at all. Lead referral. We all make money. But I cannot pay you for that, or you cannot pay me for that. That's what RESPA does. Those are kickbacks. So to assist in informing and educating borrowers, RESPA requires lenders to provide the loan applicant with a loan information booklet and a loan estimate. At the end, they must provide you with a closing disclosure. Don't worry, Tiana, I'm going to zoom in a second. You don't have to come through the camera. Don't worry. Now, what are these disclosures? The Consumer Financial Bureau requires lenders to provide two specific forms to disclose the settlement costs. A lender must provide a loan estimate, or LE, right? Forget H24 because nobody's going to ask you about H24 except for the students. Right? Nobody asked about H24, right, Ms. Mother? Or H25. It's called loan estimate. And they have to provide it to you within 3, oh, why they don't put this in the book, 3 business days of receiving the loan application. We have a summary coming up in a second where that shows this again. But again, the loan estimate, which is like the TILA disclosures, right? The loan estimate must be provided to the applicant within 3 business days of applying for the loan. Okay? So you got to get a loan estimate within 3 business days of application. Loan estimate, LE, I'm going to start saying LE from now on, LE within 3 business days of application. Okay? And you must allow the buyer to see the closing disclosure, or CD, closing disclosure, 3 business days, again, 3 business days before the closing. Okay? So, again, there's 2 disclosures that are required to be given to you. 2 disclosures. One is the LE, the other one is the CD. Both of these have a 3 business day mark. The LE is 3 business days from application. The CD is 3 business days before the closing. Okay, so one is 3 business days after you applied for it. The other one is 3 business days before the closing. They're easy to remember because one is an estimate. So obviously, if it's an estimate, it's right at the beginning. The other one is a closing disclosure, so it's at the closing. Okay, so LE, if you remember, LE within 3 business days of application, CD at least 3 business days before closing. All right? And there's another thing that must be given to you, which is a home loan toolkit. The home loan toolkit, guys, the home loan toolkit is very simple. It's a document, right? A booklet that explains everything that we're going over here right now. They're going to talk about points. They're going to talk about credit scores, how they affect you. They're going to talk about the power of shopping around, right, for different loans. It talks about how to save yourself from headaches, like meaning how to prepare yourself in case there's a hiccup in your life. So it gives you a bunch of different things to know about a loan or getting into a mortgage, and even the closing costs and closing procedures. It talks about it. Even includes a copy of a CD. Okay. Disclosures that the lender must give to you. Hold on a second, I'm sorry. Sam's asking, RESPA tells lenders to do that. So these disclosures are between TILA and RESPA, right? I'm going to explain that better in a little bit, because TILA and RESPA, as of October 3rd of 2015, they merged into TRID, which is TILA and RESPA integrated disclosures. So when you're asking me, Sam, does RESPA do this? Well, RESPA and TILA combined require certain things like settlement charges, title charges, recording fees, reserve deposits requires, tax insurance escrow deposits, fees, and closing costs. But yes, mainly this section is RESPA, mainly. Yeah. Okay. Valerie's asking, what is consummation closing? So usually the loan closes. I mentioned earlier, the loan closes at the time of closing. So right before the actual closing, which is transfer from seller to buyer, right before the actual closing, the loan needs to clear. That's called the closing of the loan. That means the money was wired from the lending institution to the escrow officer, so whoever is conducting the closing. Okay? So once the money hits the account, the loan is closed, and now we do the actual closing, which is transfer from seller to buyer. So usually that happens the same day, and the 3 business days for the CD must be 3 business days before closing. Okay? So that's the consummation of the loan. All right. Federal National Flood Insurance Act. Well, it says it all. Flood and insurance. Right? If it's a federally related loan, then you must obtain flood insurance. That's what it is. All right, give me a thumbs up. Okay. If you're happy and you know it, there you go. All right, cool. Some of you clap your hands. Some of you are like, this guy. All right, guys. Tomorrow we're going to go over mortgage market, because we're going to talk about primary, secondary market. And then we're going to talk also in the second half, we're going to talk about conventional loans, FHA loans, and VA loans. And special types of loans that can help you even if you don't have any money whatsoever. Right? But that's for tomorrow, not today. Right? So guys, if you don't have any questions, right, because you haven't had many questions. Sam, I appreciate your questions, even though you were distracted for half of the time, but I appreciate your questions. Always gonna mess with you. If you don't have any questions, guys, YouTube, Zoomers, I wish you an amazing rest of your day. I'll see you tomorrow at 10. All right? Thank you, guys.